Welcome to the Dev Journal. I am Sloan. We are witnessing a strange paradox in modern computing where engineers achieve 10 million requests per second through pure architectural elegance, while the finance departments simultaneously pour hundreds of billions into massive data centers. It is a tension between doing more with less and spending more to survive. Today we explore how Tokio version 2.0 is pushing the boundaries of Rust asynchronous runtimes to staggering new heights. We will also dive into the world of robotics, where physical intelligence has unveiled a 15-minute memory system for the newest large vision language models, potentially changing how machines perceive and interact with our physical world.
Sloan, those engineering wins are impressive. But I am looking at the balance sheet for Alphabet as cloud backlogs face off against rising capital expenditures for artificial intelligence. We also have to break down why Apple is pivoting toward budget product launches to capture market share, while their research costs for new features continue to skyrocket.
Vance, it sounds like the accountants are just as busy as the developers this quarter. From mathematical equations hidden inside deep learning models to the 21-day outlook for the largest global technology companies, we have much to unpack. Let us start with the engineering marvel claiming to redefine performance for the entire Rust ecosystem.
Looking at these 2026 benchmarks, processing 10 million requests per second in a Rust asynchronous environment is a staggering achievement. The redesigned work-stealing executor isn't just a minor update. It represents a generational leap for infrastructure, delivering 18% higher throughput when compared against the established Actix web framework. Beyond raw speed, the efficiency here is what catches my eye. Maintaining a minimal memory footprint of only 3.5 megabytes per worker thread allows engineers to pack global-scale infrastructure into remarkably tight hardware constraints. This level of density is what enables modern systems to remain responsive, even under the most extreme traffic spikes. I'm also closely watching the hierarchical timing wheels, which have reduced the total central processing unit cycles spent on timer wake-ups by 40% compared to earlier versions. That is a massive amount of reclaimed compute power that previously went to waste just managing the internal state of the runtime itself. For real-time trading platforms, moving from 12 millisecond tail latency down to sub-5 millisecond tail latency creates a competitive advantage measured in pure financial gains. Sloan, how do these raw engineering benchmarks for the runtime translate into the broader market strategy for the companies actually building on this foundation?
Those sub-microsecond latency figures at this massive scale are the fundamental prerequisite for the next decade of global real-time services. When we see a 12% increase in requests per second for microservices running on Axum and Tokio version 2.0, we are talking about tangible improvements in how consumers experience digital products daily. Reducing central processing unit cycles by 40% does more than just speed things up. It directly translates to significantly lower cloud operational costs for enterprise users. In an era where data center spending is under intense scrutiny, these efficiency gains represent millions of dollars in savings for large-scale deployments across the globe. The implementation of a unified multi-producer, single consumer application programming interface also resulted in a 30% reduction in code churn during legacy system migrations. This means developers spend less time fighting with the runtime and more time shipping features, which is vital for maintaining a competitive edge in fast-moving markets. We are seeing a shift from optimizing the runtime executor to optimizing the neural network layers themselves via symbolic translation. This brings us to a new tool called SymTorch, which is a library designed for translating deep learning models into pure mathematical equations, allowing for a deeper understanding of how these complex systems function. Researchers at the University of Cambridge have introduced a library called SymTorch that turns the black box of neural networks into readable math. Using a process they call wrap-distill-switch, they can take a complex graph neural network and pull out fundamental laws like the 1/r² gravity law directly from the edge messages. This level of transparency is a massive step forward for scientific computing, as it allows us to verify what these models are actually learning. When the system distilled physics informed neural networks into the one-dimensional heat equation, it achieved an incredibly precise mean squared error of 7.40 times 10 to the negative 6th power. Beyond the scientific applications, there is a practical case for replacing heavy multi-layer perceptron layers with mathematical surrogates in models like QN 2.5. We saw token throughput jump by 8.3%, moving from 4,878.82 to 5,280, 1.42 tokens per second. It is rare to see a tool that offers both a window into the model's logic and a significant performance boost at the same time. Vance, how do you see this trade-off between mathematical simplicity and the raw predictive power we usually expect from these massive transformer architectures when accuracy is on the line?
While that throughput gain is certainly a win for infrastructure teams, we have to look closely at the cost of that simplification. In the QN 2.5 1.5 billion parameter model, that distillation process caused the perplexity to climb from 10.62 up to 13.76, which is a significant quality loss. This library also gives us a blunt reality check on how these models actually function under the hood. For instance, an analysis of Llama 3.21 billion revealed it is not actually doing exact arithmetic for 3-digit multiplication. Instead, it is relying on systematic numerical heuristics, essentially just guessing based on patterns instead of calculating. The fact that we need principal component analysis for dimensionality reduction during this distillation process shows the inherent friction in mapping high-dimensional weights to closed-form equations. We are essentially forcing a complex, nonlinear system into a rigid mathematical box, and the resulting increase in model error suggests we are losing vital nuance in that translation. Understanding these internal mathematical shortcuts helps us realize how much these models are still just approximating logic rather than truly reasoning. Now we should move from the abstract math of neural networks to the physical reality of robots navigating the real world, where they need far more than just symbolic heuristics to survive and thrive.
The leap from robots that only react to the immediate second to machines that can remember 15 minutes of history is a massive shift for physical intelligence. Researchers from Stanford and the Massachusetts Institute of Technology are pushing vision-language action models into a new era where context finally matches the world. We can see the immediate impact of this long-term memory in simple household chores like opening a refrigerator. When a robot does not know which way the hinges swing, having that 15-minute buffer allows it to learn from its own recent movements, leading to a 62% increase in task success. This system works by creating semantic summaries of events, such as noting that it has already placed 3 bowls on a counter. By bridging the gap between low-level motor commands and high-level recipe goals, these models are starting to understand the sequence of a task rather than just the next frame. It is a fascinating bridge between cognitive planning and physical execution, but it raises massive questions about how we actually compute all that data in real time. Vance, how are they managing to process 15 minutes of video data without the graphics processing unit essentially melting under the pressure of those massive attention layers?
The secret to avoiding a total hardware meltdown lies in how they restructured the attention mechanism from a quadratic nightmare to something manageable. By implementing space-time separable attention, the team reduced the computational complexity from big O notation n squared k squared down to big O notation n squared plus nk by interleaving spatial and causal temporal layers. Even with those mathematical shortcuts, the margins are incredibly thin when you are running the Pi 0.6 vision language action backbone on a single NVIDIA H100. They are processing 16 observation frames while fighting to stay under the 380 millisecond real-time inference barrier. required for smooth robotic motion. While the success rates in the lab are promising, relying on a 4 billion parameter backbone for embodied tasks creates a significant bottleneck for latency and power consumption. We are seeing a delicate dance between the need for sophisticated reasoning and the harsh physical reality of processing power at the edge of the network.
The sheer scale of the hardware required to run these embodied models brings us back to the massive investments currently reshaping the industry. Let us pivot from the technical breakthroughs in artificial intelligence memory to the massive financial capital required to build the clouds that host them as we look at Alphabet. The momentum inside the Google Cloud segment is reaching a fever pitch with 48% year-over-year growth. This expansion is fueled by a staggering $240 billion backlog in enterprise artificial intelligence demand. It suggests that the massive infrastructure investments are finally translating into significant top-line revenue for the company. Holding a $3.67 trillion market cap requires immense operational efficiency to satisfy the street. Alphabet is managing this with a net margin of 32.81% and a massive cash reserve of $126.84 billion. These figures provide a significant cushion for the business. We also have to consider the incredible scale of their consumer reach, with the Gemini artificial intelligence models now serving 750 million monthly active users. This massive user base creates a proprietary data loop that few competitors can hope to replicate, serving as a primary catalyst for upcoming monetization efforts across their platforms. By leveraging that volume of user data, they are positioning themselves to dominate the next phase of the software cycle. It is a bold play that relies on the sheer density of their ecosystem to stay ahead of newer rivals. However, this level of dominance requires a physical foundation that comes with a breathtaking price tag.
Sloan, you mentioned that physical foundation, and I find myself staring at the bill coming due for all that hardware. When you look at the projected capital expenditure ramp, the sheer cost of maintaining that lead becomes terrifying. We are moving into a period of intense spending that could reshape their balance sheet. The projected capital expenditure for 2026 and 2027 is estimated between $140 billion and $185 billion. This massive ramp represents a significant threat to future free cash flow that many investors seem to be ignoring. While the cloud is growing, center construction costs are accelerating. Institutional sentiment is already reflecting this tension between growth and spending. While Woodline partners increase their stake, others like Alua Capital and 3G Capital have trimmed their positions due to these margin risks. Even with a 59.65% gross margin, maintaining profitability becomes difficult when spending $91.45 billion annually. Technically, the stock is sitting in an interesting spot with a relative strength index of 41.75. This suggests the shares are currently oversold compared to the average analyst price target of $376.86. Compare Alphabet's infrastructure-heavy strategy with Apple's tactical shift toward budget-friendly hardware volume.
Apple is taking a surprising turn toward the budget consumer by launching the MacBook Neo and the iPhone 17e. These devices are hitting the market at a $599 price point. It is a strategic move designed to capture a massive amount of market share before the April 30th earnings report. This volume play is intended to expand their ecosystem into segments that were previously priced out of the premium hardware cycle. By lowering the entry barrier, they are growing their total addressable market significantly. It is an attempt to maintain their 6.43% year-over-year revenue growth through sheer quantity of sales. Even with these cheaper products, the company maintains a staggering return on equity of 152.02%. This high efficiency suggests that they can handle the shift in product mix without losing their operational edge. It is all about building a broader foundation for their services revenue to grow upon in the future. While the shares are currently trading around $262.52, the average analyst target sits much higher at $293.29. This suggests a potential 5% price increase over the next 21 days as the market adjusts to this aggressive new hardware strategy.
Sloan, looking at the spreadsheet makes me wonder if that volume can actually pay for itself, given the current supply chain environment. Memory inflation risks are a serious threat that could easily compress the net margin of 26.92% on these new low-cost devices. High volume becomes a liability if your margins evaporate. The balance sheet is also showing some uncharacteristic strain for a company with a $3.86 trillion market capitalization. A current ratio of 0.89 suggests short-term liquidity constraints that we rarely see from this leadership team. It makes the aggressive push into budget hardware feel more like a necessity than a choice. We also have to account for the relative strength index, which is sitting at 38.91. While that indicates the stock is nearing oversold territory, technical indicators cannot solve the geopolitical macro uncertainty coming from the Iran conflict. Wedbush analysts are identifying those tensions as a primary headwind that could stall any short-term momentum. A high return on equity is impressive, but it does not protect a company from shifting global winds and rising component costs. We have to contrast Apple's consumer-facing hardware risks with the institutional and regulatory turmoil currently facing Galaxy Digital. That firm is dealing with a probe and deepening losses that present a far darker picture. Moving from Apple's liquidity questions to Galaxy Digital, we see a much more concerning balance sheet. Reporting a net loss of $481.7 million in the fourth quarter of 2025 alone is staggering. When you add a regulatory investigation for potential securities fraud, the situation becomes volatile for investors. That quarterly hit contributed to a total annual net loss of $241 million. With a beta of 3.69, this stock is moving nearly 4 times as much as the broader market. That extreme sensitivity, combined with an earnings miss of this magnitude, explains why the regulators are investigating. The problem lies in their heavy reliance on digital asset prices, which have been brutal lately. A 50% decline in Bitcoin prices from peak levels essentially gutted their primary revenue stream. Even with a consensus buy rating, a trailing net margin of negative 0.40% suggests the business model is currently broken. They are trying to pivot by spending $160 million on one-off charges related to mining and reorganization. It feels like a desperate attempt to move away from the volatility of tokens and toward something more tangible. Sloan, I wonder if these heavy infrastructure investments can actually save a company bleeding cash.
While the losses are heavy, the pivot toward high-performance computing infrastructure is a clever survival strategy. Securing approval from the Electric Reliability Council of Texas for 1.6 gigawatts of power capacity at the Helios data center is a massive win. It transforms what could have been a dead mining facility into artificial intelligence assets. This move effectively hedges their crypto exposure by repurposing existing hardware for the booming data center market. Despite a negative free cash flow of $18.55 million, the long-term value of that power capacity is undeniable. It explains why analysts maintain a price target of $41.83. Today, we have seen 2 different paths to navigating a shifting economic landscape. Apple is leaning into high-volume hardware to widen its ecosystem, while Galaxy Digital is converting crypto liabilities into artificial intelligence infrastructure. Both companies prove that success in 2026 requires a brutal focus on where the next capital flows. Whether through software efficiency or capital-intensive data centers, the winners pivot before the market forces their hand. That concludes our coverage for today. Join us next time on the Dev Journal as we track the engineering and economic trends defining our technical future. Until then, I am Sloan.
Seeing Tokio 2.0 hit 10 million requests per second in Rust reminds us that engineering efficiency still has a ceiling. When you contrast that technical precision with the staggering billions in capital expenditure required for Alphabet to clear its cloud backlog, the gap between software optimization and hardware reality becomes impossible to ignore.
That hardware reality is precisely where the pressure mounts for every engineering team today. Whether we are translating deep learning models into equations or watching Apple pivot toward budget hardware to capture volume, the theme remains the same. Every software gain is eventually met by the massive cost of global physical scale. As we navigate this era of 10 million requests per second runtimes and multi-billion-dollar data center builds, remember that technology is never just about the code. It is about the economic trade-offs that determine which innovations survive. Thank you for listening to the Dev Journal. I look forward to our next deep dive.